Hello, everyone. I'm Anthony, and thanks for having me here today. So now we have just learned from Plato about the future of the carbon trading and the opportunities for Hong Kong as a green finance center of the world. Now, in the next 10 minutes, I would like to share with you all on two things. First of all, from an investment standpoint, how the use of ESG data will be able to help us to identify risk and opportunities. And the second one, we will then look at how to navigate across ESG data and analytics. Right, so this is the what we call the spectrum in terms of investment. So on the very left-hand side, you've got the traditional investment, which has nothing too much to do with sustainable, responsible investing. On the far right-hand side is philanthropy, right? It's about impact, but not too much about generating returns. So what we've got in between, we call it ESG investing. You will see it's like 6 major buckets. In fact, it's defined by the GSIA, the Global Sustainable Investment Alliance, as the major ESG investing strategies. Now, if you are if you are looking down there, you'll see the impact intention. You know, some of them are pretty passive. You will see strategies like passive, a negative screening or positive screening. They are like do no harm, so they avoid the bad stuff, right? But some of them are actually have extra or more punchy thing that they want to achieve. So down there, you'll see benefits including like either help you to manage the portfolio ESG risk or help you to identify alpha opportunities in terms of investment or managing your portfolios. Now, people are asking, so why ESG investing to start with, right? And many would probably, and some of you probably say, oh, because you want to obviously, you know, like generate positive impact to the environment, as Plato has just outlined, or to the society, to the community that we live in. Now, I would say yes, but before that, there's one thing it is even more important, which is making money. Okay, so and for institutional investors, we call it alpha generation. Now, if you look at this slide, this is the most quoted academic study in the world. It's a meta-analysis of over 25,000 academic studies over the last 25 to 30 years, and examining the ESG performance of the company across the world, and also the CFP, the corporate financial returns, which includes share price return as one of the key metrics. Now, the interesting part is right there, you know, on the red box on the right-hand side, emerging markets, where Hong Kong, China belongs to. So China accounts for, so taking MSCI as an example, index as an example, China's account for more than 60% of the emerging markets benchmark. So Asia, ex-Japan, Latin America, you know, or even EMEA, you know, these are where ESG works the best. Okay, I think that is something that we'd like to look at. Now, if we drill into a little further, now the yellow line that you are having is the MSCI EM benchmarks that I've just shared with you, right? The blue line is actually the secret recipe for portfolio manager, which I used to be running emerging market mandates back in London. And that's the secret recipe to get you to be the top rank or top percentile portfolio managers in the EM space. So probably some of you will recognize, you know, the deep V that we have experienced over a decade ago, the global financial crisis, right? 2008, 07, 08. And since then, the interesting part is if you invest in good ESG company, as defined by the blue line, so using very simple metrics of MSCI ESG rating of AA or above, you know, in the emerging markets, the blue line is the alpha that you would have generated over the last 10 years. The interesting part is, if you look at it on an annualized basis, it's not just outperform in the good years, but also, not just outperform in the bad years, because some people would say ESG companies are quality stocks. So for markets like, you know, we are facing this year, then of course ESG is going to do well because it's lower beta, lower volatility, you know, blah, blah, right? Not quite so. In fact, you know, with the exception for I haven't got 2022 here because we still have got 2 months to go, but with the exceptions of 2018, which is like largely in line, like losing by 40 basis points, you could actually see that there's on average more than 400 basis points of outperformance if you invest in good ESG company in the emerging markets over the last 10 years. And I've seen some of the very seasoned investors here, but I guess, to find one which could consistently outperform at that rate would not be the easiest task, in the world. So that's the opportunities and the benefits. I think it's very clear. Now, the next thing is about obviously on the risk side, right? So the list that you are seeing is something that a lot of institutional investors would call exclusion list traditionally. And here, at my firm, because we are actually long-short fund managers, we actually have a more, nimble approach, and we could actually express our ESG risk on both long position and short positions. As a result, there are names that we would actually bucket it as, heightened ESG risk. What you are seeing, some of them will be traditionally viewed as, like the scene industry, right? The weapons, the gambling, etc. So not creating a lot of positive social impact. But what we are seeing here is we want to see, something that's, decades ahead. So for example, we care about, whether decarbonization or net zero is happening. So as a result, we are also putting fossil fuels as a very heightened ESG risk in the portfolios. So, these are some of the things that we have been putting in mind and helping us to identify not just short-term, but also longer-term risks that would be pricing in. In fact, you would be seeing that a lot of ESG data vendors are starting to look at companies' returns profile, for example, CFROI, cash flow return on investment, at different carbon prices. So, for certain companies, CFROI could be, ranging 8 to 10%, over a 5 to 7 year time horizon, or even look at like 20 years long cycle. But pricing in carbon prices at 50 or 75 or $100 per ton, the CFROI just drops significantly from 10% to 5 to 6%. And that is where we need to price in our valuation model. Now, the second part, how to navigate across data and analytics. So I heard that, there are some very exciting ventures and platforms within Cyberport which are, pioneering the development of, fintech in the ESG space, which so allowed me to share 2 cents about, as a user and institutional investors, what would make sense. Now, obviously, I'm sure those some of those ventures would be in the red, boxes, right? That's where you are seeing the flow of the ESG data information across the whole ecosystem, and that's where you will be, inputting via sell side or brokers or analysts to asset managers like us, and even the asset owners, which is the ultimate holder of the biggest, AUM globally. I want to share with you the story about people sometimes could be data are meant to be scientific and methodological. I would like to share you the other side of the story, which is the superstitions of it. So this is one of the research that is actually very well known, that they are checking with a lot of institutional investors globally about what do they think are the best source of information to learn about a company ESG performance. So basically, ranging from 41% doing in-house proprietary research, which people should be more proud of, to reading or digesting or dissecting company ESG report, 50%, to 55%, where you were given direct access and meet with the CEO of the company and to learn about the sustainability strategy. Unfortunately, they all ranked on par or below than corporate ESG ratings. Okay, so I think this report actually, and together with all the big names, which some of you may probably come across, I'm sure, this is something that this is the reality of the market. Investors are heavily rely on corporate ESG ratings in assessing corporate ESG performance. So the questions now for the floor is that, is ESG investing just about evaluating scoring, or there's something that's beyond that? Now, my 2 cents for it is obviously it's a good starting point. So there are several ways that I've suggested here, either to complement or supplement the investment research that institutional investors do, or to actually not just evaluating company level, but also on portfolio level ESG performance. But more importantly, is actually help us in terms of the engagement process. So engagement is when investors talk to portfolio companies and say, like not just the margins, but also how's the ESG performance and strategy trending for the company as a whole in the longer run, and what are the biggest industry trend that is affecting the business. And that's changed the behavior of the corporate world, because you will be directly interacting with the C-suite and ultimately shaping their strategy. Now, this is something that I would like to share with you, or IOSCO, which is the International Federation of the Financial Regulators, now being chaired by Ashley Alder, the CEO of SFC, has just completed a consultation last year, and that's the consultation conclusions out last November. It's actually saying that, international financial regulators are looking very closely, if not scrutinizing, the ESG data space. So essentially, there are several limitations that the financial regulators looks at. So this is the first piece of advice. Do take a look of this consultation conclusion. The second part is, so what's the way forward? And my very honest answer is to address the pain points of the asset managers. Here, I'm sharing with you 5 of them, which we believe that, asset managers would struggle with the ESG raters and analytics. Some of the data are a little bit, quite backward-looking, not forward-looking. There is over-reliance of company disclosures, and also, especially we talked about the coverage of this part of the world. Some of the ESG raters particularly have a country focus in China or Asia, which is trying to address that. So outside developed markets part is actually improving a lot in the last 24 months. But the conflicting signals is something that the IOSCO consultation has also been very critical on. So and finally, in terms of transparency. So my 2 cents is that for all the exciting platforms that is going to not just helping the financial markets of Hong Kong and also developing or generating positive impact for the environment, do pay attention to these pain points of the institutional investor sets. And that was going to differentiate you from the rest of the pack. So with that, thank you very much. And now I'm going to learn from all the other panelists and from the representatives from the exchange. Thank you.